Welcome to our live Q&A, everyone. It's 7 o'clock, so we'll get started. And so we'll have an hour together. And I think at the moment, probably what's in everyone's minds is what's going on with equity markets selling off. We have had a fairly turbulent beginning to the year. Nasdaq in particular has been heavily hit, and all of those meme stocks, which did incredibly well last year, have now really started to sell off quite considerably. It also looks like a kind of small cap growth sell-off in the US. So, I think it's just simply the case that if interest rates are increasing, that's going to take some of the froth out of markets. But whether this turns into a bigger sell-off, we'll have to see. Usually there's some kind of liquidity problem which triggers the sell-off in a broader market. But I think we're still a long way off that. So if we do look at the actual returns, you'll see that it's not catastrophic. So if we have a quick look at COIFIN, you can see that if we look at the returns over the last month or so, sure, the Nasdaq has sold off quite a bit, but compared to just a month ago, it's still above where it started. Of course, if we look back over a year, you can see that wobble is much less significant. So, it's not really very, very big at all, because we're still up by 23% for Nasdaq, 26% for the S&P compared to where we were a year ago. So I think, I'd just take this thing in context and look at the historic returns and don't anchor based on your all-time high, because that'll make you panic, and that kind of cognitive bias will only lose you money, because it'll trigger your sale of your equity, and then you could be locked out of markets as they snap back. Most of the time these sell-offs are fairly short and fairly shallow. It could be different this time, but I really wouldn't panic about it at this point. So calm, right? Everyone should be calm. Right, so back to the questions. Usual story, if you're a supporter, then you get pushed to the front of the queue in terms of questions. So that means you support us on YouTube. It's very cheap to do that. We've made sure that's the case. And that way you get a nice little crown next to your name so that we know you're one of our supporters. And then when Laura sees that you're asking a question, it'll get popped into a document, so I'll know it's you. And I'll thank you, obviously, for supporting us. So please do support us. Alternatively, you can do a super chat, and that's another way to help us financially, obviously. So if you could do that, it would be great. And Teddy will be assisting, as always. I've had to lure him into my office with some snacks. He really didn't want to come today. I don't know why. He's had a haircut, so he's a bit traumatized by that. He's not as fluffy as usual, are you, Ted? No. So he has lost a lot of fur. But still, he looks beautiful, I think. Okay, so let's get started with the questions. And don't forget you can like and share the stream. So, first question. Let me just switch back to me. Okay. So the first question is from Tim Manchester, who says, "Hi Ramin, my portfolio is full of growth ETFs, tech, innovation, green energy. Sadly, well in the red now. Oh no, I'm sorry to hear that. Isn't it the right time to sell them and move to something more conservative, like a generic ETF?" Yeah, and Tim goes on to say, "In the current environment, I'm worried the pain in these stocks will last for months as the narrative about tapering inflation, rates, yields continues, and algos do their bit too. Thank you." Well, always, Tim, it's always good to pretend that you're coming to your portfolio fresh each day. I'm not saying you should trade every day as if you've got a completely new portfolio. That'll make you overtrade hideously. What I'm saying is that keep a record of why you bought what you did in your trading diary, and aim to buy things which you'll hold on to for a long period of time. Now, if you still believe the thesis, which is that tech, innovation, green energy are the way to go, then surely you'd like those even more at these lower prices. Now, I know it's tempting to sell, but the difficulty always when you think about selling, what if this is just a 10% fall and that's it? Then suddenly markets snap back. You'll be locked out of the market. Okay, you'll be in a more diversified ETF, which you might be happier in. So that's the way to consider it. Would you be happy holding that ETF, the broad, globally diversified ETF, for a long period of time? And I suspect the answer is no, because that's not really what you believe in. And at a certain point, I think you have to have a conviction in your beliefs, even if market prices move against you. So it's impossible to know whether this is just going to turn around quickly or not. So that's the risk that you face. So as long as you're switching into another type of equity, kind of a different tilt to your portfolio, away from your innovation tilt, more kind of to market neutral, market cap weighted allocation, that's okay. And as long as it doesn't generate too much in terms of crystallized gains, which generate a tax implication, or maybe if you have trading costs which are big, many of us don't have that anymore. So as long as that cost isn't high, then yeah, why not? Why not switch? But I wouldn't move out of risky assets because prices are falling. That's always a bad idea, and it'll probably mean you underperform if you do. So just make sure that what you buy is something you're happy with. But if the underlying thesis hasn't changed, I'd be tempted to stick with your convictions. Now, if your conviction is that buying companies which don't generate a profit is a good idea, I'd question that belief, because historically, when interest rates increase, that's generally made companies which have very high valuations, high relative to their income and their profits, those are the ones which probably suffer the most because there's very little fundamental support for those equities. Whereas a company which is like an earnings juggernaut, clearly, even if interest rates are much higher, it'll still be an attractive company because it still produces the goods. So I'd be careful about profitless companies, which kind of promise you huge growth in the future, like Cathie Wood's funds, because obviously Cathie Wood's taken a huge drubbing in markets because that's very much her style of investing. If that's your tilt, then yeah, maybe a move away from that would be a good thing anyway. I mean, I was warning people about this a long time ago, which is that valuation does matter. Disruption's great, but you've got to be able to produce the goods in terms of profits. And just a promise is very tentative, because all that keeps that company afloat in terms of high equity prices is belief, right? So it's the narrative which is pushing up the valuation. So it's price to earnings multiple multiplied by earnings gives you the market price. And if the earnings are not there, then, the fundamental support isn't there. And people were saying things like valuation doesn't matter anymore. I'll buy at any price because this is a great company. Well, that's just bullshit, right? And we're now seeing that's the case. And you do get mean reversion when we're in a kind of slightly less promising macro backdrop, which is kind of the world we're about to enter, I think, where the Fed support's gone and the fiscal support looks weaker than we expected. So yeah, I definitely think that profitless growth companies were never a good idea in the first place. But I think the market is just coming around to that realization again, right? It's realized that many times in the past. Okay, so next question is from... we've got a supporter question. We've got two supporter questions. The first one is from Geordie Grasso. Thank you, Geordie, for being one of our supporters on YouTube. Remember, you can join us as well. You can just have to click on join in the description box underneath the video, and then you can be one of our supporters too, or just do a live chat and we'll answer your question first. And Geordie says, hi Ramin, are there any market environments in which short-term futures prices, 3 months to expiry, deviate sensibly from the tracked asset price, excluding contango and backwardation? Thank you. Well, I mean, Okay, so the shape of the futures curve is different for different asset types, and really what drives the futures curve in this. So let's say you want to deliver something in the future. So let's say you want to deliver a basket of S&P stocks to me in the future. So I buy a basket of stocks from you for 3 months forward. The cost of that to me as a market maker for the futures is I go out and buy the stocks today. I have to fund that out of my own pocket. I'm probably an investment bank, right? So the cost of funding would be very low for 3 months. So I pay for that out of my pocket. So that'll be a cost to me. And I have to go out and buy the stocks, but I've borrowed money to buy them. And then one of the benefits of my holding those stocks is the dividend I receive over the next 3 months. So the benefit is the dividend. The cost is the funding cost, which is now very close to zero in this environment. So really it's mostly the dividend. So the futures price will simply reflect that cost of carry to me. And I'll pass that on to you with a little bit of bid offer spread. So for a kind of futures contract where you're delivering a storable good like equity, like bonds, a bond future, or even crypto, right? So there you've got a storage cost. In those environments, for those types of asset, the difference between the future and the spot price, the price in the spot market today and the futures price, will just reflect the cost of carry. So it'll be 3 months times the expected dividend over the next 3 months. So that's a quarter of a year times the expected annual dividend minus the cost of the funding, which is almost zero for equity and for Bitcoin too. Some things you can't store. And in those cases, the futures price reflects belief about what the price will be in 3 months' time. So energy futures. Energy is very difficult to store, so the futures price there does reflect beliefs about where the thing will be in 3 months' time. Gold is storable, so in that case, you've got the cost of carry again. So it really depends on the type of futures contract we're talking about, what the difference between the price of the futures contract is and the spot price is. So I guess what you're talking about is commodities where that's not the case, where it can't be stored. I'll see if I can guess from your question whether that's the case. No, I mean, it's difficult to tell from your question what type of futures you were thinking of. But, I mean, generally, that's what drives the difference between the two, between the futures and between the spot and the spot price. Now, as the expiry of the contract approaches, obviously the cost of carry goes to zero and the futures price converges with the spot price. So it really depends on that cost of carry. And if it's a speculative type of future where you're just concerned about it's not a storable asset, then it'll be driven by speculation about what the price will be in 3 months' time. So that is the driver of the curve. So for commodities like oil, generally the front end contracts go up in value when people have a big demand for physical delivery. So that would be when there's a shortage of supply, for example, but that would be what drives the dynamics. In the case of volatility futures, again, it's a weird thing. You also have VIX futures, for example, and there normally the curve is upward sloping if you haven't got a crisis on your hands and VIX is low. But then when there's a crisis, the whole curve inverts and you get kind of backwardation in VIX futures. So it really depends on the underlying asset, what drives the dynamics of the futures curve. So it really depends on that. So I hope that answered your question. I think I covered a lot of a lot of underlyings there. Right, next question. Also from a supporter. Thank you, Stephen J, who says, do you know of another project with investment potential like Bitcoin, that only a small community of knowledge of, only a small number of cyberpunks knew about Bitcoin in 2009 to 2011. Thanks. No, in a word. I mean, the danger always, if you try and invest in one of these tiny coins, is that, you are investing in a scam. So that's always a worry. I mean, my personal approach, which I'll be using this year, which I'll be sharing with our members on Patreon probably, is to take a kind of momentum approach where we look at the largest, say, 20 coins by market cap. And that would include coins like Shiba Inu, for example. And then you look at momentum in the broad crypto market, and then you get exposure when the momentum is positive, not now. And then you choose the certain number of the best ones with the highest momentum when it's a kind of risk-on environment. So there's no kind of analysis in that kind of approach other than backtesting the strategy to see whether it would work or not. But to find these tiny little coins where you have to do all of your due diligence and work out whether it's a valid coin, whether it's a fraud, whether it sounds sensible from a technological perspective, I'm not the person to ask about that. But certainly for the crypto side, yeah, we will be talking about that strategy with our members on Patreon this year, I'm hoping. And that'll be my strategy, certainly for this year, and probably after that. So back to the questions, and what have we got? We've got Steve Johnson, who says, it seems 2022, or at least the first half of it, may not be the year for stocks. What are your views? Will we have a repeat of 2018? The Fed has already set things on motion for that. Yeah, I guess. So 2018, earnings growth was still pretty good in 2018. It was 2019 when earnings growth kind of fizzled out for 3 quarters. Effectively, it was 0 for 3 quarters. And so I think that will be quite different in 2022 in the sense that we're still seeing the big year-on-year increase in earnings, and that still provides a pretty good backdrop for equity. We do have the worry about the Fed raising interest rates faster than expected. Remember, that's what spooked markets over the last couple of days. It's when, the Fed can say that they're going to raise interest rates, and that's not scary if they're raising interest rates because the economy is strong and recovering, and if it's not too high in terms of interest rates to start with, which it isn't. We're still at very, very, very low rates. But what spooked markets was the fact they said we may have to raise it faster than we said. Right? That's what we saw in the minutes of the FOMC yesterday. So, that's what's going to spook markets. But this kind of spooking process of markets is usually fairly short-lived because markets will panic initially, but then you have to see, well, why is the Fed raising interest rates? Is it because they're just scared of inflation, or is it also because the jobs market is improving in the US? Well, it is improving. If you look at the number of quits, the quit rate in the United States, people are more confident in their work, so they are leaving their jobs voluntarily also at the fastest rate for some time. And that suggests that the jobs market is in a fairly good position now. It's certainly healed hugely compared to where we were last year. And that's a positive story, right? Because if people are employed, they're earning, and that's good for corporate earnings. So, I think that's a positive story. And the Fed is raising interest rates for good reasons as well as bad. And the bad, of course, is high inflation. So I have looked at, how long inflation would take to come down. I'd expect 4 or 5 months, even if we go back to trend growth rates in prices. If we don't get house prices continuing to rise, and if we don't see rental rates continuing to rise, those are the kind of worrying components of inflation, because those will be more sticky. And they also have a huge weighting in the CPI measure. So, I don't think it's going to be terrible. I think the Fed will probably step back from hiking rates if markets sell off a lot. But it really does depend on how bad inflation is. Because if you read the minutes, it's pretty clear that they are spooked by high inflation, understandably, because it's their job. So I think it won't be as bad as 2018 wasn't bad. So I think my central case is that we have a wobble at the beginning of the year. Inflation starts to kind of gradually fall, and then the Fed does start to taper. Has three hikes as they say they will, and then markets kind of go back to reasonable growth, not great growth, because what we saw last year was exceptionally high, and the year before. So I think it's probably going to be lower growth, but still positive. So I wouldn't cut my equity allocation right now, because I still think there's a lot of upside, and there are reasons to be positive, right? So that's how I see 2022, my central case. I mean, I did make a video about the tail risks as well, which you have to consider, but the central case I still think is a positive one. So next question is, let me just check whether the members have asked. Yes, we have. Oh, we've got a super chat. Thank you very much. Question from M. Armady. Thank you for the super chat, by the way. Our thoughts on Scottish Mortgage Investment Trust price at the moment and potential entry points. Okay, so let's have a look at Scottish Mortgage, and I'm guessing this is going to be quite ugly. I'll warn you now. So if you're not familiar with it, Scottish Mortgage is the UK equivalent of Cathie Wood, but with proper governance. So let's have a look for 2 years, just so you can see the kind of context. Right, so this is what it looks like. Scottish Mortgage had, so after the pandemic, you could see that it had an unbelievable rally, just like Cathie Wood's. And that was up 200% over the course of 2020. And then in 2021, at the beginning, there was a nasty shock, and then it rallied again by 48%. And since then, it's been falling quite sharply. So it's given back a lot of its gains from 2021, not all of them, but a lot of them. So is it cheap now? Well, what I usually look at, if it's going to be something like an investment trust, then it's worth looking at the net asset value, because you can see if it's trading at a premium or a discount. And at the moment, the green line is the net asset value. The black line is the price of the fund, and it currently looks like it's trading at a discount. Previously, you can see the price was above the net asset value. It was trading at a premium, and generally that happens when it underperforms. So if we have a look at the summary, usually it gives a Z score. So you can see the Z score tells you that it's about 1% below. It's got a 1% discount relative to the price, and that Z score is not particularly big, so that's a fairly small discount. So it is looking a little bit cheap based on that measure. Now, when I say it's got a better governance than better governance than Cathie Wood's, what I mean by that is it's actually got a board, because it's an investment trust, and they ensure that the fund managers don't do anything too dodgy, and if they do anything dodgy, they fire them, right? That's the job of the board. Whereas it just feels as if Cathie Wood's has no pushback from anyone. So if she says something, it just goes, right? Whereas there is a kind of checks and balances process with Scottish Mortgage if they go off-piste. So this is the allocation. You can see it is fairly concentrated. Some of these stocks will be off exchange, so they'll be private. So for example, SpaceX is one of their holdings. I don't think you can see it here, but it's not in the top 10. But they do hold SpaceX. But a lot of the growth companies that you can see here are the ones which have sold off recently. So would I buy it now? Probably not. Would I buy it if it was 50% lower than it is today, I probably would. Yeah. But that price to NAV ratio is a good thing to monitor if it's an investment trust. So at the moment, probably not, is your answer, M. Armady. And thank you for your super chat. Next question from a supporter. Thank you, Mick Carmelengo, who, if you do want to support us, just click on the join button, and it's fairly cheap. You know, you're only charged every month, and that way you help us, you support us, and you get your questions answered first. And Mick says, regarding crypto, it's very interesting what's going on with the ISO 20022 compliant coins, as well as Hashgraph. There we go. So I think that's actually an answer to the question from Stephen J. He was asking about whether there are any small cryptocurrencies which are very promising at the moment. So maybe that's the thing to monitor, to look at the ISO 20022 compliant coins and the hash graph. There we go. So Gary Cunningham says, also a supporter. Thank you, Gary, long-term supporter. Hi, Ramin. Would you say that the massive rise of index funds has changed how the markets react to positive or negative news? I think actually what's more important is the number of retail investors which are driving market prices now. So I think many retail investors entered the space, 2021. People who'd never traded before in their lives now have an app, they can trade very easily. And I mean, that's just a fact, right? I think that's a bigger driver than index funds. I think a lot of those investors bought into the idea that they could buy single stocks or crypto and generate huge returns. And for them, the focus was very short term, and they were looking for multi-baggers, stocks which increase in value by multiples, and they wanted to get rich quick. Well, I think what's good about these sell-offs is that they teach everyone, including the new participants, that that's not what investing is about. It's about the long game. It's about looking at fundamentals as well. It's about diversification. And it's also about managing your expectations. You shouldn't be expecting 20% returns every year. You should be expecting 6% returns above inflation on average for the rest of your life. And, expecting a 20% return for the rest of your life is simply not achievable. So it's very unlikely to happen. So I think index funds are less important than this experience of a sell-off and losing money, because hopefully the people who are losing money are young, so for them it's not a huge blow, and it's just a learning experience. My mother always used to tell me, if you're young and you make a mistake, it's not a problem. If you're old and you make a mistake, that's a problem. If you're young and you make a mistake, you just learn. And so I think that could be a positive. And if anything, I think this will bring more money into index funds as people realize stock selection doesn't usually work. Crypto won't always outperform. You do have these very large drawdowns, and the incredible returns that we've had in the past may not persist forever. So I think that will be the outcome. Actually, more people moving into index funds as they make the same realizations that many people have made in the past. So no, I don't think index funds have made a massive difference to market reactions. I think many index funds, for example, are very sticky. So if someone's got money in a global equity tracker, at the first sign of trouble, they're not going to pull out of... What's that? Oh dear.
Full screen.
Laura's saying full screen. There we go. Ted, treat. Yeah, I've got to bribe my own dog, unfortunately, to stay with me. He heard Laura's voice and he wants to go. So yeah, I think index funds are probably not the driver of what we're seeing in markets right now. If anything, they're making people more likely to stick with risky assets. So no, I don't think that's the problem. people like to say that index funds are responsible for bigger sell-offs, but I just don't buy that argument, because for a long time mutual funds were very much tied to a benchmark, just as index funds are today, and yet we didn't see that causing instability in markets. So all that's really happened is that instead of active management, we've got passive management. I think that's a big difference. So, you know, I think passive money is actually a lot stickier than people think, and people don't sell at the drop of a hat. Next question is from Geordie again. Thank you, Geordie, who says, assuming we're talking about an S&P 500 future. Okay, so this was a question you asked before, Geordie. If in one day the S&P 500 goes up by 2%, will the future also go up by around 2%? Yes, it would, yeah. Are there occasions in which the future will move less? No, because remember that, you know, so the way the actual futures price works in this case, let me just write that down as an equation. So again, I'm going to share my screen and forget to flip back. So Laura will have to shout down the stairs again. So here we go. So bad writing alert. So the futures price, that's F, is equal to the spot price times 1 plus RT. So this R is your cost of carry. T is the time to expiry. And S is the spot price. So that's the price you see in the for the S&P right today, and this is your futures price. So you can see that if S increases, F will increase as well, because F is just a multiple of S. So depending on what this is, you know, the beta will be roughly equal to 1. R is usually quite small. T is usually quite small. So this is usually a few percent different from, will only make a few percent difference to the futures price relative to the spot price. So that's why usually the two track each other very closely. It's not the case that you'll have a huge deviation of one from the other. So usually those two will be very close. So that's the case for S&P futures. If there is a difference between the two, clearly you'd have an arbitrage opportunity. So, and the futures market is so liquid, particularly for S&P futures and for the S&P itself, that, you know, that arbitrage would be very cheap to do and very profitable, you know, if there was a discrepancy between the two. But it is just the cost of carry that's different between the two. Right, next question is not from one of our supporters. So I'll move back to the live stream questions. And the next question is from Belinda, who says, can ETF providers change the fee they charge us to increase it, charging us more whenever they decide to? If so, will that only affect future purchases of the ETF and not existing holders? Well, generally the way these things get charged, Belinda, is, let's say the fee on a fund like ARK, for example, is 0.75% per year. What they'll do is they'll subtract a little bit of return every day. So it'll be 1/252th of 0.75% every day. So let's work out what that is. So if we've got 0.75% and we're subtracting a 252th of it, so that's like 0.003% is subtracted from your return every day, right? Every trading day. So if that changes tomorrow, all it means is, you know, if it's a lower fee, all it means is that they're going to subtract a little bit less tomorrow. So your return will be slightly higher, but not noticeably higher. You wouldn't even see this on a graph if you plot the price. So if they charge more or less, then you'll only see that as a slightly different return from what you'd expect if there was no fee, because that's the way ETF fees are charged. So it can be done on the sly, but clearly there are rules about them being able to do that. And of course, if somebody does increase their fees, everyone's going to notice, because a lot of people monitor that kind of thing. And in today's markets, there's a huge competition to keep fees low. People call this the Vanguard effect, right? Because Vanguard really pushed the envelope in terms of low fees, and many other fund managers have had to keep track with their low fees, including active managers. So we do have them to thank for that. But can it be done secretly? I suppose so, but somebody would be bound to notice, and they would get in big trouble unless they announced it to the entire market. Interesting question. I mean, I wonder why you asked that, Belinda. Do you suspect that somebody's increased their fee? Right, the next question is from a member. So, oh, brilliant, Ned Flanders. Good name. I think I've spoken to Ned before. And Ned says, can you please explain the difference between 3 times daily leverage and why it's different to 3 times non-daily leverage? Hope that makes sense. Thanks. Okay, so let's say that let's say you buy one of these 3 times levered funds, and I put $100 into one of them, an S&P tracker, say, which gives you 3 times the daily return of the S&P. Now, historically, there have been periods when, in 2008, for example, where there was a 98% drawdown. So in other words, my 100 would have turned into 2 if I'd have bought at the top. But it would never go negative. So I'm never asked to post more money. The worst that can happen is I just lose almost all of my money. So that's the way a leverage fund works. You never owe more than you've invested. Now imagine a slightly different scenario where instead of investing 100, I borrow $99 from my $1 invested. And I go out and I buy S&P, an S&P tracker with my total invested amount, which is still 100, but only $1 of that is invested by me. Now, what would happen if the S&P then fell by 50%? Well, suddenly I'm looking at a loss which is very much larger than my invested amount. I've only invested $1, and yet the losses I've made put me deep into the red. I'm owing more than I invested, and I'm going to have to pay that money back, right? Regardless of whether markets have gone up or down. So now we're in a situation where we've got a market position which is deeply negative, and I could actually lose many times more than I invested. So if we multiply this up, imagine I'd invested 100,000 of my money, but still had that 100-fold leverage. Well, that would wipe me out, right? That would make me not just bankrupt, but never able to repay that money. So that's the danger of leverage, which is that you could end up owing more than you invested. Whereas with a 3 times daily fund, the worst that can happen, I know it's still awful, is that you lose almost everything. But usually with a 3 times levered fund, the long ones anyway, it does recover, because after a crash, usually you get big positive returns which are amplified, and it does recover to previous highs. It just takes a while. But those drawdowns can take a long time to recover from. That's all I'd say. So that's the difference between leverage which you create by borrowing money to invest money, and leverage 3 times daily leverage, say, which is that I'd say 3 times daily leverage is much less dangerous, because you can never owe more than you invest. And that's why it's generally a bad idea to have too much leverage. Plus you get margin calls and it's not pleasant. Next question is from another super chat, I think, from Carl, who says, thoughts on energy for sector rotation out of tech. Let me just check. Yeah, I haven't heard Laura shout, so I think I'm still okay. Thoughts on energy for sector rotation out of tech. Right, so let's have a look at energy prices, and just so that we have some idea of where we are. So if we go to cross-asset benchmarks and we go to oil, so let's use WTI. Here we go. So let's look at a longer period, 5 years say. So this is where we are with the oil price right now. Currently it's coming up to $80 a barrel for West Texas Intermediate. You can see it's very volatile. It's very difficult to predict. Nobody can reliably predict energy prices. Clearly we're getting increased demand at the moment because we're still kind of moving away from a period where we had less economic activity and less people traveling in their cars. So that's going to be a positive for oil. I think in terms of new supply, clearly many energy companies have not been able to invest in finding new reserves because they're kind of running things down, right? They're trying to transition away from fossil fuels at the moment. So, I think in that kind of environment, the supply will be limited. The demand will still be there, largely from the US, which is still very slow to move away from fossil fuels, but also from countries like China, India, which also are taking a long time to move away from fossil fuels. Europe, I think, is kind of interesting because there's a much more rapid move to non-fossil fuel usage and non-fossil fuel energy generation and green energy. But for the US, China, which are the big users of energy on a global scale, clearly that's taking a while. So the demand will still be there for fossil fuels for a while, several years, I'd say, 5, maybe longer, maybe even 10 years. There'll still be very strong demand for fossil fuels. There'll be a limited supply. So you could say that actually in this environment, that's fairly bullish for oil prices. I'd never try to make a forecast for oil because it's an almost unimaginably difficult thing to forecast. I knew some oil strategists when I was at an investment bank, and I always thought they were very brave because they always got it wrong. But still, yeah, I think in the kind of twilight years of fossil fuels, that could be an interesting sector to go for. And if we do look at the sector performance, so if we look at, let's have a look at sectors in the US. Here we go, US sectors. And if we look over a 3-year period, you can see energy is right here at the bottom. So it's the one that crashed the most in 2020, and it's also rallied the most since then. So if we look at which performance over the last year, you can see that energy's actually been the best performer. It's up 60% over the last year. I'm not sharing my screen this time, right? So Laura did shout in the end. There we go. Yeah, so there we go. So what I was showing you before, or not showing you, was this is the price of oil. So fairly volatile, big fall in 2020, and then a huge rally in 2021. And then if we look at sectors, over the last 3 years, energy's been the worst performer, only up 20% in the US. Over the last year, it's the best performer, so up about 60%. So I guess your question is, does it have further to run? And I'd say actually yes, I do think it's going to be a good performer for a while because of that fairly high demand, which is still increasing, and at the same time fairly limited supply. But obviously this is a sector which is undergoing a transformation where that could be quite an expensive transformation. And if that's the case, then this is not a good long-term play. It is a sector which would have to transform, otherwise some of these companies are going to go extinct. Because if we do generate our energy not using fossil fuels, clearly if they don't change, they'll cease to operate. So yeah, certainly over the next 3 to 5 years, I think that could be an interesting play, in answer to your question. Right, so switch back to me. Right. And I guess what you're talking about also is moving out of tech, because tech has been doing so well, but not clearly doing well over the beginning of this year. So would that be a good sector to go for? Probably. Another sector that's typically good when the curve is steepening, the yield curve, is financials, because banks tend to do fairly well when the yield curve is steepening, because they tend to fund themselves at the short end of the curve, they lend at the long end of the curve, so the differential between the two generates some of their revenue, their lending revenue. It's the net interest margin. So that's a typical sector that does well when yield curves are steepening. So if the curve continues to steepen, then yeah, that'll be good for the financial sector. So higher interest rates aren't necessarily bad for banks, for example. And there are other sectors where that correlation is not strongly negative, as it is for tech. So yeah, I think yeah, energy is an interesting sector still. But do I invest in single sectors ever? No, it's very unusual for me to do that. Okay, next question is from, so we had Belinda. We're back on Timothy's question. And Timothy says, any views on how the Fed and other central banks tightening and liftoffs this year will affect stocks and cryptocurrencies? Yeah, I mean, I discussed this earlier, but I think interest rate hikes themselves are not bad for equity. I think they have taken some of the froth out of some unprofitable companies. So small cap growth has been completely hammered, as has Cathie Wood, who tends to buy those kind of unprofitable growth companies. Not all of her companies are unprofitable. Tesla, for example, is very profitable now, but many of them are. So I think that's one of the effects of increasing interest rates. The other one is going to be, if you can, so let's imagine that 10-year yields for US Treasuries get closer to, say, 4%, right? Well, suddenly gold becomes much less attractive. If you can just sit there with almost zero risk lending money to the US government, and then you can earn 4% per year, then any asset which just doesn't generate an income suddenly looks much less attractive. So, any cryptocurrency which doesn't generate an income becomes less attractive. Gold becomes less attractive. Any wasting asset becomes attractive. And in order for equity to be attractive, it has to generate higher returns as a result of that. So I think that it does change the landscape when the risk-free rate is increasing. And it's not a good look for a cryptocurrency. It's not a good look for unprofitable companies or very interest rate sensitive companies. And those would be ones which are heavily funded in the corporate bond market, where their cost of funding increases, or companies which in some other way are indirectly affected by interest rates in a negative way in terms of their revenue. But yeah, I think that the Fed raising interest rates per se is not a bad thing for equity, because rates are still low. The economy is improving. The jobs market is improving across much of the world. And supply chains bottlenecks are easing. So there's a lot to be positive about. It's easy to forget that, but I think that's the case. Right. The next question is from Agatha. Agatha says, one sec, let me just check. All right. Yes, Agatha says, is there any way to value Bitcoin? What about other crypto assets like Ethereum? Maybe based on the usage of the respective blockchain, future value of adoption, or something related. Yeah, that's kind of interesting. Certainly for Bitcoin, I think it's much harder to value. I think the stock flow models are a non-starter because they equate scarcity with value, which is clearly nonsense, right? Just because something's scarce doesn't mean it's valuable. I think Ethereum, you've got a better chance, right? Because there you could say, well, if it's kind of underpinning the NFT market, you can work out roughly what the NFT market's worth. And if that runs on Ethereum, that's the big assumption. It could switch to another blockchain. But if it's running on Ethereum, you can work out what the discounted cash flows are from that, maybe. I'm just guessing here. So that might be a way to do it. That's quite interesting, Agatha. I've not seen anyone do that. I haven't looked very hard, I have to say. But generally with crypto, I think the valuation arguments usually depend on, well, it's always the same case, right? If you want to work out the value of something, you have to work out its future cash flows or guess them and then discount them using some risk-free rate plus a spread, kind of risk premium. So, the risk premium would be chunky for something like a cryptocurrency because the risk of substitution is quite high. There may be a new cryptocurrency, a new blockchain technology that comes along which supplants Ethereum because it's faster or better or more secure. So the risk premium would be pretty high, I suspect, and that would reduce the present value. But you've got to come up with some way of working out what those future cash flows are, and then you can come up with a price. But certainly at the moment, I haven't seen any kind of convincing valuation models for crypto. But that's how they'd work, I think. Right, next question is from James Hendry. So we have 8 minutes left, so running out of time. But James says, hi Ramin, thoughts on the current price of Scottish mortgage? I think we had that one. Yes, we did. Dave C says, is it time to go all in on SARK? That's the short ARK fund. So if ARK goes up, you make a loss. If ARK goes down, you make a profit. So if you want to short Cathy Wood's fund, ARK, then you go for SARK. I mean, I wouldn't short it. I just keep away from it because all you can really say is that it's very unpredictable and very volatile in this environment for a fund that buys unprofitable companies and which is price insensitive, which is what I found most egregiously bad about Cathy Wood's style of investing. It's kind of price insensitive, but that can kind of come in and out of favor. So even being short is risky. I just keep away from it. Sunita Loshande says, good evening, Ramin. Hope you had a nice time off. Good Christmas and New Year's. Yes, it was great. Thank you. Laura and I had quite a relaxing time for a few days. My question surrounds SMT, Scottish Mortgage, and BBOX, which is a real estate investment trust, which does large distribution centres for Amazon, for example, is one of the types of property they run. SMT has dropped by a substantial amount, yet NAV is lower. When's the best time to buy? Well, look, even if you bought now and held on to it for 10 years, it would probably be good, long term. Trying to call the bottom of the market, it's almost impossible. But I think there's still a little bit of fluff around some of the kinds of companies, the growth companies, which Scottish Mortgage, for example, buys. So I still don't think this is like a cheap time to buy. Look at the price to NAV. We discussed that earlier. You can watch that video in replay to see what I mean. And that's one measure. Another one is look at the general valuation measure for the S&P. You've got that available from multiple sources. When that gets to a reasonable value, then, like the average forward price to earnings multiple, then this is a fairly cheap point for the equity market. And then you'd buy risky assets like SMT, maybe even, ARK. So that's generally the way I do it. I'd look at a valuation measure for a broad index to know when I'd be happy to load up on risky high beta investments. Next question is from Richard Spataro. He says, how does an S&P 500 GB, so Great Britain ETF, work with regards to timing? It trades during the UK open hours when the market in the US is closed. Yeah, I mean, it's still got the futures market, so you could still kind of get a reading from that. But there will be periods when the UK version is trading, but the US market's closed. So if that's the case, then you'll notice that they do get, when the US market opens, if it has got big, majorly out of line, then there will be a snapping back to what you'd expect, right? So the sterling version of the S&P. So, there will be a discrepancy, but it ends as soon as that market opens. But until then, it's just a guess, right? But then the minute the US market opens, the arbitrage trade, which keeps the price of the ETF in line with the price of the underlying index, suddenly kicks back in, and that's why they snap back into line. But the futures market, as I say, is another proxy. So probably it'll be trading off the futures if the futures market is open. If no market is open, then yeah, it'll just be a guess. Next question. Let's see if we've got any other member questions before we end. We haven't. Okay. Next question is from BMBM365. What's your favourite individual UK stock? My UK portfolio has been doing very well since buying at the lows and still very good value. Okay. I don't really know. I mean, I don't really buy single stocks, to be honest. So, I'm not the right person to ask about that. If I had to buy one, what would it be? It would probably be something to do... I mean, I could buy an investment trust, for example. So Scottish Mortgage would probably be the one I'd buy. Not at these prices, probably at a lower price. But generally, I don't buy single stocks, so I'm not the right person to ask, I'm afraid. Ite Zucker says, can we explain why US TIPS bonds are down over the last 2 months, even though inflation is rising? Thank you. So the thing to understand about TIPS is they're still sensitive to interest rates. So if the real interest rate, that's the yield minus inflation, if that's increasing, usually because people are pricing in higher growth, GDP growth for the US, then the price of the TIPS will fall. So you're not insensitive to interest rates. You do benefit from high inflation because that's built into the principal and the coupon on the TIPS. But it's still the case that if real yields increase, the value of your TIPS fund will fall. And don't forget that the Fed's been buying TIPS like crazy. They own quite a big chunk of that market. And as they unwind, they'll be selling a fairly big chunk. Well, not selling, but they'll allow them to mature without reinvesting back into the TIPS market. So that kind of tailwind, which is Fed buying, is going to go away gradually, not very gradually, because they're going to taper fast. So that support is gone. And then inflation gradually will start to ease off. That's what many people expect. And again, that'll be a headwind. But over the last 2 months, it's been because real yields have been increasing. So if we look, we can certainly look at yields. I don't know how to look at real yields on here, but I'll just quickly share my screen again just before we end. And global yields. So this is for the US. And if we look at the last 1 year, you can see that it's certainly at the short end of the curve, yields have been increasing in the US, but also at the 10-year and the 20-year part of the curve, and some of that will be real yield increases. which is negative for tips. So let me finish there. Thank you all for joining us. Remember, you can subscribe and you can like us, and you can also join our membership. So Patreon is how we run our membership currently. So you'd go to patreon.com/pensioncraft and you can join our online community. And also don't forget to like and subscribe if you just like to see our future videos. I work hard to make those videos interesting, and certainly lots of people seem to like them. So we've been successful to some extent. And have a great 2 weeks, and we'll see you in 2 weeks' time.